go ahead and turn this over to our presenters and get started.
My name is Brenda Blunt. I'm partner with Eide. I work exclusively with tax-exempt organizations. I'm part of the tax-exempt industry is, I think, the fourth largest industry in Eide, and we have devoted a lot of resources to it. We do have an industry group, and I'm on the executive committee as well as I guess, advisor member of the NTO. And Christine, you want to introduce yourself and then fire this up?
Yeah, thank you so much, Brenda. Again, as Amy mentioned, welcome everyone to our session today. So my name is Christine Perez, and I'm a manager in Eide Bailly's National Tax Office, where I specialize in exempt organization tax. All right, so here's our agenda for today. It's kind of a quick overview of all of the topics we're going to cover. So our focus is, of course, on UBI and siloing. So we'll go over just quickly some background information to make sure everyone is on board. Then we'll jump into the overview of some previous guidance that was issued. And then we'll jump into and walk through kind of the overview of the major provisions of the proposed regulations that have been released. At the end of the session, we'll wrap up with a few topics that are related to siloing and NOLs. And then if we have time, we will open it up to questions. So here's just a quick slide that gives an overview of UBI. And really this slide kind of gives us that basis for our discussion today. Really when we talk about 512A6 and the siloing provisions, we're talking about how we're required to essentially group and report our unrelated business income, or UBI. So UBI is of course defined as a trade or business that is regularly carried on and is not substantially related to the furtherance of the organization's kind of tax exempt or main purpose. Really what makes the 512A6 rules here important is the fact that a tax exempt organization can have more than one type of UBI, trade or business activity. So it becomes important for us to understand what activities we have and to be able to silo those. So I'm sure many of us remember a time, a few years ago previously, pre-512A6, when reporting for unrelated business income was relatively simple. Previously, your organization was likely able to determine UBTI, unrelated business taxable income, by taking its aggregate gross income from all of its activities and then reducing that amount, simply by the total aggregate of deductions that were allowed. And it was really simple. It was relatively easy and it was clean. And so this really was just one big pot that an organization, in a sense, could compile all of their UBI activities. And at the end of the day, they either had income to report or a loss. Example of what it used to look like. And organization A has a quarterly publication. They have advertising space in there that they generate UBI. They also have a parking lot, and sometimes that parking lot is profitable. They allow outside users to utilize the parking for a fee. So as long in the past as organization could prove that there was a profit motive for this parking lot, that they sometimes had losses and sometimes had revenues for, they were technically able to take those two activities and essentially net or aggregate them together in previous years. So in previous years, if that advertising had a gain, that gain would be able to offset any losses from that parking revenue. So now with Section 512A6, this was really added by the Tax Cuts and Jobs Act of 2017, and it changed the way that the UBIT calculations are completed for any exempt organization that has more than one trade or business activity. So really what happens is the UBTI, it's computed separately with respect to each trade or business without regard to the Section 512B12, that $1,000 deduction. And really what we do is we come in and we say no UBTI for a single business will be less than 0. And then we go in and take everything that is more than 0 for these UBTI amounts for these different silos, and the organization computes its UBTI for the year. Now this is applicable to tax years that are beginning after December 31st, 2017. So it applies for those tax years 2018 and later. And of course, it applies again to those exempt organizations with more than one trade or business in order to silo. And then siloing, of course, is this calculation of UBTI separately. So we've got this little representation here, and I think this kind of visually shows what we're talking about with siloing. I think Brenda really wishes we had a picture of some grain silos here, but we are working with what training and development was able to give us. But siloing really is the concept that's about calculating UBTI separately for each unrelated trade or business. And we have a quick note at the bottom, because while this requirement to silo certainly does have, an additional layer of compliance and complexity, but it also might have some significant impact on these organizations that were previously allowed to, dump all of their activities, say, in one pot and offset the losses of one activity against gains of another. So that's that example we talked about. When we can't do that anymore, depending on your new siloing categories, this may not be allowed, and many organizations may now find themselves subject to UBTI and UBIT, the tax, either this year or in coming years. So I believe I'm going to turn it over to Brenda here.
I'm just going to talk a little bit about the evolution of the rules here in Tax Cut and Jobs Act. Back in very late 2017, passed this rule. And the reason that Congress passed this rule appears to really have been at the request of the Department of Treasury and the Internal Revenue Service. What they had seen in the industry and what the different congressional committees who have keep an eye on the not-for-profit industry had seen is the prior rule of having a profit motive. If you had an activity that wasn't directly advancing your exempt purpose in some way other than to generate money, if that activity was not generated for profit, you haven't really ever been allowed to take those losses and use it to offset income from an unrelated activity that did have a profit motive and was making money. And of course, sometimes there's a profit motive and we're just bad at it, and we're just figuring it out and we lose money. But if a number of years go by and you don't make money at a particular activity, the presumption is under the old law that there was not a profit motive and you couldn't take those losses to offset income anyway. So a lot of commenters on this process have said, we already had law that took care of this issue. We don't need this additional law. But the IRS said it's very difficult for them to audit everybody and find who is not respecting that additional rule. And so this law puts more of a spotlight on activities and creates more of a really arbitrary, and as we get into the rules, you'll see it's somewhat arbitrary, set of lines in the sand, so that there's a more clear mechanism to keep the activities with no profit motive from being pursued, arguably to lower the tax on the activities with a profit motive. So that's where the law came from. But as Christine mentioned, you're supposed to silo your activities into separate trades or businesses. The problem with that is that there isn't anything in the current statutory environment or any regulatory definitions of what is a trade or business. And we all need to know what a trade or business is to silo it. We can guess, and when we do guess, we guess in our own best interest or in the best interest of our client. Our challenge is, how is the IRS going to guess under audit, and how ugly are those audits going to be? And so in August of 2018, about 8 months after the law passed, the IRS gave us notice 2018-67. The notice itself is not law. It really gives us a safe harbor position. The IRS had a lot on their plate with the Tax Cut and Jobs Act. They couldn't give us clear guidance out of the gate. Plus, this was a new concept for them too, and they really didn't know what good guidance would look like. And I'm not saying that as a critique against the IRS. The IRS themselves understood that there's a lot to trying to define trade or business, and they wanted input from the community. So, but they knew we needed guidance, so they gave us a safe harbor. The safe harbor rules said, first and foremost, you can use any reasonable good faith attempt to identify your separate trades or businesses. You can use any reasonable good faith attempts to the rules, good faith interpretations of what UBI is, good faith interpretation of what a separate trade or business is. But in the event you're looking for more clear guidance, we will just say that using the NAICS code system will by definition be a good faith effort to determine what a trade or business is. And they said going out to the 6-digit codes. Now, I had, prior to this law, a passing familiarity with the NAICS code system. A lot of people don't. It is a system of classifying business activities for purposes really of tracking the census and understanding what businesses are out there and classifying those industries largely for statistical and census purposes. It's done in coordination with Mexico and Canada so that we can share information about businesses across borders and really get a picture of what people are doing in North America in terms of trades or businesses. That is not designed to administer the tax law. The NAICS system is reevaluated every 5 years, and certain classifications go away or change. And a lot of the commenters to the notice said that that's going to create havoc with the tax rules if every 5 years the rules change in terms of what bucket you're in. So we'll get to how that was addressed in a minute. Allowed to use a good faith, reasonable approach consistently applied to allocating expenses to those trades or businesses, but they are looking for identifying expenses that are directly connected with the trade or business. You certainly can't do here's the gross revenue in this one trade or business, here's the gross revenue for an organization as the whole. This unrelated trade or business is 5% of the total revenue, so we're going to take 5% of all expenses and allocate it to that trade or business. I've heard CPAs actually argue that that was a legitimate approach. The IRS and the Department of Treasury is pretty sure it's not. So the law actually says we're looking for directly connected. That does allow for the allocation of overhead, but there needs to be a pretty solid line between those overhead functions and that trade or business. The IRS acknowledged that in some cases, particularly in the investment world, this is going to be a nightmare. It's still going to be super hard for some organizations, but they needed a system that's going to be administratively something that they could administer from an enforcement standpoint and something that we could comply with on our side. So they did suggest a certain number of rules for handling investment activities, which the concept of those rules survived to the proposed regs, which we'll get to in a minute, but there were changes. And so I'm not going to go into what those rules actually were in the notice because we're going to go to it more depth when we get to the proposed regs. So, but they put this notice out to create a safe harbor. The next thing that happens in the rulemaking process is they issue proposed regs. They ask for comments at each step of the way because IRS really does want practical comments from the field about this. And so it really has been a collaborative effort. To date, we as practitioners who have submitted suggestions haven't gotten everything that we want, but that's not how this works, but they are listening. So it has evolved, and I think it will continue to evolve somewhat. They specifically requested comments on the notice about siloing provisions and methods for identifying those separate trades or businesses. So if you want to go to the next slide, just an overview, you would identify your silos. If an organization had 3 different silos, you would calculate the unrelated business taxable income from each one of those 3 trades or businesses. You can't create a loss in any one trade or business that can be used to offset the income for another. So if any one of those particular silos had a loss, the loss portion, we become a net operating loss carry forward for that particular trade or business. And so when we get to this math about what tax we're actually going to pay this year, there is no silo can have less than 0 in this math. So we're going to take our pluses, not subtract out any of our negatives to get to a number. We still get the $1,000 specific deduction, and that is, in short, our total UBI, and that's what you would pay tax on. I should say there are some other deductions you get. You get a charitable contribution deduction as well, and we'll get into that a little bit more here in these proposed regs. So the proposed regs came out about 9 months later. They came out April 23rd, 2020, right in the middle of the pandemic and our super extended tax season. The original, the notice had 36 pages. The proposed regs just have 8. That does not make the proposed regs simpler. The proposed regs also came with a preamble that was 115 pages, but the actual itself is 8 pages, and it does create some clarity, gives us some additional guidance. It is still proposed regs, so at this point it's not yet law. It is really an evolved safe harbor provision. If you follow these regulations and have a good faith, a reasonable effort to follow these regulations, the IRS won't come back and assess you tax and penalties if you follow these regulations. If you take your own path and say, well, I'm going to come up with my own reasonable attempt to interpret the law, then they're free to disagree whether or not that was reasonable or not. There are still some issues that are not yet addressed, and there was a comment period that closed in June. They did get a lot of comments on the proposed regs. The AICPA, the American Institute of CPAs, the American Bar Association, and a number of other organizations sent in their comments. We hope that we will have final regulations published by the end of the year, but people still need to file their tax returns. They still need to make their estimated payments. And so we have these proposed regulations to use as a safe harbor, and to the extent we choose not to follow them, we have a baseline to see how far away from what the IRS is thinking that we're getting. So just going a little bit further into the proposed regs. So the next slide, if you would. One of the big changes is the IRS moved away from using the 6-digit NAICS codes to the 2-digit NAICS codes. In the history of the NAICS system, the 2-digit code classifications have never changed. And so the IRS believes that they have solved the issue of some other government body who doesn't care at all about the tax impacts, changing the classifications within the system. They think using the 2-digit NAICS code system addressed that issue. It also did a couple of other things. It created bigger buckets for us to group activities in. And so previously, using the 6-digit NAICS code system, you might have had 2 different kinds of retail operations. One might have been selling wine, one might have been selling apparel. Those would have been 2 different trades or businesses under the 6-digit NAICS code. They're probably under the same 2-digit though, NAICS code. So if last time you filed a return, you were subject to the siloing rules and you were using the 6-digit NAICS code, you'll want to relook at it and see if you can group some activities that you previously couldn't, because now we can use the 2-digit NAICS code. Also give us some more definitions. It's a little bit more workable in terms of the investment income, which we'll dig into for a moment. If your investment income is interest income, for instance, this is pretty simple, but if you have a very diversified investment portfolio with a lot of partnership interests, this rule is really critical to help make a terribly complicated area slightly less complicated. Particularly if you have tiered partnership is you invest in a partnership and that partnership has invested in partnerships that have invested in partnerships that have invested in partnerships. The rules that have been around forever have used a look-through approach. So you look through to the actual whatever has been generating income at that lower tier, and you have to ask yourself, if I did that activity directly, would that be unrelated business income or not? So if the activity at the bottom of all those tiers of partnerships was rental real estate that was not debt financed, and if I were a 501c3 organization, I don't have unrelated business income for rental real estate unless it's debt financed. So I could if I could look through all those layers and see, oh, that's rental real estate revenue, it's not debt financed, I wouldn't have to pay unrelated business income tax on it if I did it myself. The fact that that's flowing through all these tiers and getting to me, I still don't have to pay unrelated business income tax. The problem is when you've got a multi-tiered investment partnership, it is really, really hard to find out what is actually generating income at the bottom. The people who put these deals together don't like to talk about what's at the bottom. If you are a small investor, you have no leverage. If you want to ask those kind of irritating questions, you can just bloody well not invest in their partnership because they're not going to tell you. Even if you're a really big organization, the people at the top might not even know what's at the bottom. So getting this information is really, really hard. And we'll go through some of the things they did to make it a little bit easier and to give you a little tiny bit of time to restructure your investment portfolio if you need to after you get an understanding of these rules. We also have these NOLs. Now we've got siloed NOLs. We've got an NOL that was generated by investment number one, by activity number one, another NOL by activity number two, activity number three maybe made money. We can't use our NOLs on 1 and 2 to offset the income from 3, but NOLs that were generated before the Tax Act happened are available for all 3 of the activities. And so there were questions, well, do we have to take a third? Can we use all the NOL for the one that made money? How does this happen? So our proposed regs give us some rules around that, complicated by another piece of legislation that happened in the interim, which we'll be talking about later. But there are questions around that, some of which are still not yet quite answered. They're answering those in the order that they think they're going to come up. So the notice really didn't answer them at all because the first year you're not generating a siloed NOL. You wouldn't have to worry about the question until year 2. So we're coming up on year 2 for a lot of organizations. They're starting to give us some rules. And then we have some clarity around how these rules affect individual retirement accounts. And the clarity around that is an individual retirement account is a trust. It's going to follow the trust rules. And so while the siloing rules still apply, you're going to pay tax at trust rates. You're going to use the charitable contribution deductions applicable to tax and those sorts of things. The proposed regulations, I talked a little about NAICS codes. The proposed regulations actually, in my mind, broke it up into kind of 2 categories. You could also argue maybe it's 4 categories. In this first group, you can use the NAICS, 2-digit NAICS codes to identify what is a trader business. And so this first group is UBI that you're conducting yourself. In the earlier example Christine mentioned, you're selling advertising in your periodical. That's something you're doing. It's not flowing through an investment. You're doing that. That's directly connected to you. You use the NAICS code to determine what bucket that goes in. We're going to be talking about QPI, but a qualified partnership investment. If it's a qualified partnership investment, all of the UBI that is in that investment gets put into a bucket, which we'll talk about below. But if it doesn't qualify, and you have to use the look-through rules to see what the actual activity was to generate the unrelated business income, you use the 2-digit NAICS rules. And the same thing with your S corporations. S corporations, it gets a little weird here because all income flowing from an S corporation investment is subject to UBI. There aren't 2-digit NAICS codes for some of those things, but if you have an S corporation that does not meet the qualified S corporation investment rules, allowing you to group up all the activities in that S corporation together, then you would use the 2-digit NAICS codes. The other ones, your investments, which includes qualified partnership investments and qualified S corp investments, that is one silo. All your taxable investments are one silo. We don't tie it to an NAICS code, it's just one silo. We also have payments from controlled entities. Under Code Section 512B13, if we have a nonprofit who controls, effectively has some subsidiaries, and the parent nonprofit charges the subsidiary interest, rent, royalties, that subsidiary takes as a deduction against taxable income, then those payments are unrelated business income tax to the parent. We have some rules around those. Effectively, every single controlled entity under the proposed regs creates a separate silo. So you might have a for-profit subsidiary that you charge interest to or rent to. You don't have to look at the various activities in that for-profit subsidiary, but that all those payments, qualified payments that you get from the controlled entity, creates one silo. If you have 20 of those sorts of subsidiaries, you're going to have 20 different silos, because right now under the proposed regs, each controlled entity creates its own silo. And then we have foreign corporation insurance income, which is we don't see a lot of, so I'm not going to spend a lot of time on, but basically, if you are getting investment income, if you have invested in a foreign corporation that is generating its income from insurance, and you have taxable investment income from that, that is going to create yet another silo. So you could have an infinite number of silos. On the top group, there's only 20 NAICS codes, so that top group, there's limited to 20 potentially silos. I can't imagine anybody being in all of them, but potentially 20 different silos. In the lower section, investments is all one silo, but you can have an infinite number of silos from your controlled entities. So you can get into a lot of weirdness there. You can go to the next slide, and I think that take it back.
Wonderful. Thanks, Brenda. So, we've kind of mentioned the 2-digit NAICS codes, or that North American Industry Classification System. And, I think that initially there was actually a lot of relief almost when the proposed regulations came out. People read through and they saw, hey, we're now allowed to use this 2-digit code system. And it really has been kind of a major highlight, or almost the first thing a lot of people have been discussing. If anyone's read anything about 512A6 and the proposed regulations, they know about this 2-digit coding. And, as Brenda mentioned, it really was, when we looked at the 6-digit, there was a lot of kind of concern that it was going to be administratively burdensome. So hopefully going to this 2-digit code, 20 codes to choose from, it's going to be a lot easier for organizations to comply. Now, organizations do, as we mentioned, they need to select that code that's representative of the UBI activity. And as we've mentioned, that NAICS code is only used once. So, we've got the note here where, as Brenda mentioned, kind of that example with 2 different types of retail, they could be grouped under the same code. And the same goes for different UBI activities that may have been separated geographically. So, if you were maybe a large hospital organization and you had locations in different states, maybe previously you looked at those as 2 separate locations or multiple locations. Now, if you have different activities, but they all go under this code, it doesn't matter the geographical location or where those activities come from if they're all grouped under this NAICS coding that is used once. And then the last
add, a lot of people thought that a trade or business could be based largely on how you accounted for it. And those different locations are often, not always, but often accounted for as separate really P&L, profit and loss statement for each location. And so there was some concern that those would all be separate trades or businesses, because there is some precedent for that kind of approach in other areas of the law. So if you have a hospital in 20 states, you just still have one trade or business. Not that the whole hospital is unrelated business income, but if you had taxable gift shops or something, or outpatient pharmacy, those multiple pharmacies would still be all one trade or business.
Yep. So hopefully that's going to reduce the burden on a lot of organizations, but it's also going to make people think, you know, as they go in to assign the codes to these activities, because the proposed regulations essentially say that as soon as you select this 2-digit code, it cannot be changed unless some sort of error was made that was unintentional. Now, this limitation does apply to the codes that are selected on the first Form 990T that's filed after the final regulations are published. But you will want to make sure that you do go through and, you know, we're setting up these 2-digit codes, and the expectation is they're not going to change for these siloed activities. So here's just our general listing of the 2-digit NAICS codes. You can see all 20 here. We've got the link of the website location, and, you know, going in and just most accurately identifying the code that's going to kind of cover that general charitable education or other purpose or function of the organization and where it fits. So, you know, when we do look at these, we want to make sure that you're putting your activity in this correct bucket. I know that the regulations did touch on the fact that, you know, a college or university, we can't go in here and pick 61 educational services and place every single activity of the college or university under code 61. Same for, you know, a club. We can't go in and select everything for, say, the golf course and toss it all under code section number, or this NAICS code number 71. So there is that limitation where you do need to look at the underlying activity and choose the NAICS code according to what that underlying activity is and what most accurately identifies that unrelated trade or business.
So I can give you an example of that. If you mentioned the country clubs, for instance, they're arts, entertainment, and recreation. If you have unrelated to business income relative to use of the golf course, you've got your green fees, for instance, that could be under code section 71, but your pro shop would not, even though country clubs have golf courses and pro shops, and even city courses have golf courses and pro shops. The pro shop would be under the retail category and not under the arts, entertainment, and recreation, even though it is commonly associated. It is part of any golf or operation you would normally see.
Yes. It looks like we've got a polling question number 1. And organizations with more than one trade or business may use a 2-digit NAICS code to silo their activities. True, false, or it depends. So most people did select true, but technically it could depend. And this is one area where Brenda kind of touched on the previous slide. A lot of those individual UBI activities, we will look at the 2-digit NAICS code, but there are some activities that will go into their own silo, such as the investments or those activities from the controlled entities. All right, so selecting that 2-digit NAICS code is one way to categorize our UBI activities. But the other large activity that everyone likes to talk about right now really is the grouping and this ability to silo these certain investments of the organization. And, you know, for most organizations, we expect that this is really going to be taking a look at these qualifying partnership interests, the QPIs. That's probably the most common investment type that we would see. So think of all those partnership K1s that you get at the end of the year. That's what we're going to be looking for here, reviewing those. Some entities will have these qualifying S corporation interests, and others will also have this debt finance property that all kind of fall into these income and investments for siloing. So here, the 512A6 and the proposed regulations are really allowing you to take all of these qualifying investments and essentially group them together as one trade or business. And again, this was another item that we kind of discussed. It's administrative relief, I think, for a lot of organizations. Could you imagine going in, and if you're someone who's invested lots of little pieces of money into partnerships, or would you want to silo or report each and every one? You know, this gives you an ability and an option here, if they fall into this qualifying partnership interest rules, to go ahead and put everything into one category or bucket. I'll kind of caveat here that with social clubs, VIBAs, and SEBs, you know, these are subject to kind of a definition of UBTI that's slightly different. So their investment activity may also include, you know, items that are described in 512B1, 2, 3, and 5, I believe. So, you know, this is kind of a general slide for most organizations. There are going to be some differences here and there. And this slide kind of follows up on that piece, where if you recall, when we talk about investments, a lot of people start to think about interest, dividends, royalties, and annuities. Those items, those are excluded typically, unless they're debt financed, they're typically excluded under this 512B1 from UBI. So when we talk about our investment siloing, we're really looking at the investments that are not excluded. So that's why we're looking at the QPI or the qualifying S Corp interests and the debt financed property, because those items fall into that category. So with investment siloing, we'll just kind of spend a minute, I guess, running through qualifying partnership interests, because we think that this is going to be one of the more common investment areas or items that a lot of organizations have. And it's where you have a partnership interest and the exempt organization is not a managing member or a general partner of this partnership. So when you have a QPI and you meet the rules, which Brenda's going to cover in a minute, the de minimis test and the control test, essentially we can say if we meet one of these rules, de minimis or control, we can go ahead and we can aggregate all of these qualifying partnership investments and interests into that one siloing bucket. So the great thing there really is that when we are able to aggregate these and report them as that one silo for investments, you can offset the gains and the losses that come through from these small lower tier and these partnership investments or these partnership K1s that you have. And once they're designated, they essentially stay in this group. So as long as they meet these tests, they will stay in this one siloed category for investments until they no longer meet these tests to be considered the QPI. So I'll turn it over to you, Brenda, to walk us through the details of the tests.
Yeah, so we've been talking about qualified partnership interest, and y'all been wondering what that means. We're finally at it. So again, cannot be a general partner, cannot be a managing member. So if you're a limited partner or not a managing member in an LLC, we look first at the de minimis test. So if your interest in the partnership, you have no more than, you have 2% or less, or no more than 2% of the profit and capital interest in the partnership, that would pass the de minimis test. And that's over that. This is tax law, so it's not quite that simple, but that's the first gate. When you look at it, you can rely on the information on your K1 if it's disclosed, if it says it's by formula, or if it's not disclosed, then you have to do your own math. We're looking at an average of the beginning end of the year to come up with a percent, and if that is 2% or less, both profit interest and capital interest have to be 2% or less, then you meet the de minimis test. The original notice required you to combine the investments from disqualified persons. The proposed regulations say you only need to combine the investment interest in that same partnership with supporting organizations and controlled organizations. So with the type 1 supporting organizations, it's easy enough to get that information theoretically. That may be hard for a type 2 or type 3, but you do have to look at what, if any of them are invested in that same partnership interest, you need to combine it to measure that 2%. If you're invested in a partnership where you have more than 2% of either profit or capital interest, that itself is not a QPI. But if that partnership is invested in other partnerships and the lower tier meets this de minimis test, then you don't have to look further than that lower tier. Everything below that one, that second tier organization, or third or fifth, or however far you have to go to get to a qualifying investment, anything below that then it will be treated as part of the investment silo. And here again, when we're talking about partnerships and what's UBI, we're only talking about the UBI that's flowing through. We're not talking about all the income flowing through, just the UBI and trying to get it in the right silo. So this does get, only have time to give you a taste for what this is, but it gives you an example. The control test, and it starts out with, if you have no more than a 20% of the capital interest in the partnership and you don't have control, that 20%, again, you can rely on what's on the K1. We've got a beginning and end of the year number and you can average them. If the information is not on the K1, you have to do your own math. If you don't pass the de minimis test, but you're under the 20% capital test, then you need to look at, you want to look at whether or not you have control. Here again, we're including the interests of supporting organizations and controlled entities, but not the interests of disqualified persons, which was suggested in the notice. Control here is not intuitive necessarily. We're looking at, do you have one or more of the following rights? If the exempt organization may, even if they don't exercise the right, but has the right to require the partnership to perform or to prevent the performance of an action that affects the operations of the performance. That is going to be, I think, a subject of numerous court cases for the rest of eternity as people decide what that is. If the exempt organization has the power to appoint or remove officers, employees, or directors, that's going to be a little bit easier to identify. If the exempt organization's own officers, directors, trustees, or employees have the right to participate in the management of the partnership, or if the EO may conduct any of the partnership business. So if the exempt organization can sign contracts on behalf of the partnership, if there's a management, shared management services kind of thing, it's going to trigger, that's going to be one of those rights. So if you don't have any of those rights and your capital interest is less than 20%, you pass the control test, and the unrelated business income flowing through to you from that partnership will be treated as taxable still, but it will be in that investment bucket. S corporations, qualifying S corporations, and all the income flowing to you from an S corporation is unrelated business income. That's the difference really here between S corporations and partnerships. If it meets either the de minimis test or the control test, you can treat it as an investment. If it doesn't, you're going to have to look at it as each S corporation is going to be treated as a separate trade or business. So here again, you're not going to use the NAICS codes, or some people say the NAICS codes. You're not going to be able to use that. Just each S corporation is its own trade or business. That kind of makes us sad that we can't use the NAICS code system to take losses and income and net with each other. But on the other hand, it makes us happy that we don't have to take that S corporation apart and identify separate trades or businesses within that S corporation. So hopefully on the net, we end up happier more often than we end up sad. But there are some pluses and minuses to this rule. But effectively, that's where we are. The proposed regs, there are some other rules. Section 501c7, which are social clubs, C9 with VIBAs, and C17s, the subs, have a different regime for UBI. So what triggers UBI and what doesn't is different for those. But once you've identified UBI within your own set of rules, particularly for those groups, then you still follow the same siloing rules, essentially. There's a few things that don't work. C7s, the proposed regs got particularly mad at and called them out in a couple of places and say, but this rule doesn't apply to you. But primarily you follow the same siloing rules. So at the end of the day, each for those organizations, each non-exempt taxable activity has to be treated as a separate trade or business activity and within these siloing rules that we just covered. So your investment income, your losses from your golf course cannot offset your investment income. That probably never was the case anyway, but now it for sure isn't the case. And you're going to report those in the separate silos in the return. I think that's about all I'm going to say on that. There is a transition rule. If you have investment partnerships, there's a transition. If you held it before August 21st, 2018, you can treat that partnership as a single trader business through to the effective date of the final regulations. After that, you have to use the same rules for that investment as for any other investment. That transition rule is not available to 501c7s. C7s typically don't invest in tiered partnerships, so I don't know how often it's going to come up, but that's really the difference for the C7s. Of interest, if you are a charity and you're trying to figure out your public support test, you can net your income and your losses from different trade or businesses to calculate your public support. You can't net them to calculate your taxable income, but you can net them to calculate your public support. It would take me another hour and a half to explain the details of how that would work, but just know that those activities do get netted for your public support purposes. Christine, I'll kick it over to you for a bit.
Awesome. So now that we kind of chatted a little bit about really the major provisions that relate to kind of that more of that income side for unrelated business income, we can kind of step back and take a 10,000-foot look at expense allocations. And the reason that we'll kind of step back and look at it is because, you know, the proposed regulations didn't really give us much that's formal, no formal guidance on these. And so it's a question of, will we see this in the future? It's quite possible. You know, the final regulations still have to come out. If the IRS and Treasury are going to decide at some point to release additional guidance, you know, we might see an additional internal revenue bulletin or that type of format come out that gives us a little bit more on expense allocations. Right now, what we do know is that they've pretty much told us that you can't use the unadjusted gross to gross method. That's just, it's not a reasonable method. They've called that out in the proposed regulations. And really, what do we mean by that? It's when, you know, an organization was to take their ratio of kind of gross income from their unrelated trade or business activity over the total gross income from that unrelated activity plus all activities, and essentially generate a ratio and apply indirect expenditures in that manner that's unadjusted. The proposed regulations do come out and say that that is not a reasonable method. You want to be applying expenditures directly where possible, or making an adjustment to the calculation so that it is reasonable for the application of those expenditures. So this slide just really kind of quickly tells us, you know, where the reporting side of this is. So we all know that the UBI flows onto our 990T. 990T used to be relatively simple, and they've gone ahead and they've added Schedule M. So really, Schedule M is where if we have the siloed activities, we've got more than one trade or business that we need to report. Schedule M is almost kind of like a duplicate copy of that front page of the 990T, and it allows us to go ahead and calculate that UBTI separately for each trade or business that needs to be reported. All right, and then NOLs, kind of one of our wrap-up topics here. As Brenda mentioned earlier, the proposed regulations did give us some NOL ordering rules. But in general, when we have an NOL that's generated from one siloed activity, we cannot use it to offset another siloed activity. Essentially, we have to wait until that siloed activity has a gain in a future year and utilize the NOL at that time. I think that's going to create some really fancy Excel schedules and reporting and tracking for a lot of organizations. But the one exception here is the CARES Act. So really, when we take a look back and we think about NOLs, I think most people will recall that a couple of years ago, you could carry back NOLs and you could carry them forward. So carry back 2, carry forward 20. The Tax Cuts and Jobs Act essentially came in and slashed that. And they said, that's it, no more carrybacks. You're carrying forward your NOLs indefinitely. So Now we had this kind of concept where we said, well, we've got this split. We've got the pre 512A6 and we've got kind of these post 512A6 enactment NOLs. And really, when we look at it, in a sense, anything that comes after that 12/31/17, it can be carried back and it can be used in aggregate. Take into effect the CARES Act. If we're going forward, anything 2018 forward, it needs to be siloed, and that NOL needs to be siloed and allocated to its specific activity. With the CARES Act, they came in, they gave us some guidance that changed the NOL limitations. They said, if you have a loss from 2018, 2019, or 2020, you can now carry it back up to 5 years. And they also slashed our 80% limitation and they made it 100%. So when we're carrying back those losses or carried over to 2019 and 2020, instead of an 80% limitation, we can take them up to 100% of our income. And then the IRS did issue an FAQ June 8th on the nonprofit NOLs that addresses these concerns that organizations had with the CARES Act and how to carry them back to the years before 12/31/17, and then anything that's carried forward to 2018 and forward does need to be siloed.
The proposed regs, the comment period is over. There were a lot of comments suggested by a number of organizations. So we are hopeful we'll get final regs before the end of the year. You can go to the next slide. The siloing rules themselves, for now, where we are is the notice. We can rely on the notice. We can rely on the proposed regs, but neither one of them are law. So we can also use any reasonable good faith interpretation that considers all the facts and circumstances of the rule. I would encourage you, though, to consider the IRS's view, because eventually when the final regs happen, we will be held accountable for the final regulations, or we'll have to disclose a departure from the final regulation in our return to alert the IRS we're not following their rules. So careful of that. We've got some resources in the slide in terms of where you can get some more information, and also just, you know, your Eide Bailey not-for-profit exempt organization tax professional is a great source of information. So
Okay, so we do have 2 questions in there.
so regarding partnership investments, isn't there a grandfathering rule that allows all UBI from partnership investments acquired prior to 8/12/21/18 to be treated as one activity, so there's no need to look through those? It's not a grandfather rule. We had hoped that it would be a grandfather rule. It's a transition rule. So between now, or between the enactment of the law and the enactment of the final proposed regulations, you can rely on the transition rule that does allow investments and partnerships prior to that date to be treated as one activity. It creates its own silo. So it's not in the investment silo with other QPIs, but it's treated as its own silo. And you can net everything from that partnership together and do not have to look through. But that transition period does expire when the final regulations become effective. And so you're buying a little bit of time to get these rules figured out with regard to that investment, but you cannot ignore these rules forever.
It looks like the question is, if you have NOLs from UBTI activities in the past years, before siloing came about, how will those be applied to income from the various silos in the future? And so, yes, this is the case where, you know, you've got an NOL from 2017, and the proposed regulations do have kind of some tiers. And then, you know, we've got a lot of organizations that are going in and having to take a look at this CARES Act implication, because, you know, we've got the, and they can technically be carried back now. So we've got these NOLs that can be, you know, taken in this year, or the organization has the option to carry them back. So you can either take them against the different silos this year because they were in aggregate before, they can be applied against the silos now, or with the CARES Act, taking them back 5 years, we've got organizations that are going to have to look to see, can we take them back, apply them in the aggregate to these 12/31 pre-2017 years pre-512A6, and then if there are still carry forwards, they would need to be siloed again for this post 12/31/17 as of 1/1/18, the siloing. Do you have anything to add there, Brenda, or?
No, except that I think we do expect to get a little more clarification on that process, and we're hoping to get a little more clarification on how that looks when you take it back and go forward in the final regs. But the general rule will be going forward, it's only going to be for that silo. There's also some questions about, well, what if you're not doing that trade or business anymore? Will this look a lot like the passive investment loss carry forwards, and that will free up that loss to be deducted against other trade or businesses, or will that be lost? I'm voting for using it for the other trades or businesses, but I think the tax law suggests it will be lost, because the primary law 216 says you can't take losses from one trade or business and offset it against the other. I think a reasonable interpretation is you will never be able to do that. So for my clients, I hope I'm wrong and they come down and free it up somehow, but I don't think they will. Gosh, that's a lot of heavy material for only 2 questions. I'm assuming everybody right now is, just going to start talking to their tax advisors and work out the details for their own organization. But appreciate your interest in the topic and getting ahead of this a little bit. So when we start having these discussions with you, when you prepare your returns, it won't be like, what? So anyway, thank you, and stay in touch. More to come.
Awesome. Thank you all so much for attending, and thank you to our presenters, and I hope everyone